Hello there. We're going to look at chapters 14, 15, 16, and 17 today. Give you some insight on these chapters. I'm going to start in chapter 14, which is on page 213 in my text. Bond and stock valuations. Stocks and bonds, that's how a company finances their business. The right side of the balance sheet I've been talking about, assets and then liabilities and equity. Liabilities and equity is how we finance our company. We need more cash. Companies do that, whether it's a Google or General Motors or whoever. They issue bonds, they sell bonds, and they're not giving up ownership. They're actually just giving a loan really to the people that they sell the bonds to. So if I'm a company like General Motors and I sell bonds, $1,000 denominations at a stated interest rate, then whoever I'm selling those bonds to expect what? They expect a return on that, like a CD at a bank. And so they expect 3%, 4%, and they want their principal back at the end when the bond matures. The 5-year bond, 10-year bond, whatever it might be. And so that's the way you finance your corporation, through issuing bonds. A second way is to give up equity in your company through issuing common stock. When you're issuing common stock, you don't have to buy that back. You may pay dividends depending on the company. Obviously, your high-tech companies like a Facebook or Google aren't going to pay a dividend because they're going to pump that money back in. And people don't care if they don't pay a dividend if the stock price is going to appreciate. So usually if there's a high dividend, the stock doesn't appreciate as much. And the opposite is true. And then you got preferred stock. This doesn't get talked about much. It is part of equity, but it normally pays a dividend, or else people wouldn't buy preferred stock. And preferred means is preference to paying dividends first. Common shareholders get their dividends second. So preferred stock acts like debt, even though it is actually stock, even though it is actually equity. A preferred stock is like common stock. You don't have to, it doesn't have a maturity. When you sell preferred stock or sell common stock, whoever buys that, it's up to them to sell that in the open market or whatever the market price is. It's not the company, it's sold. They've raised the cash. And in the case of common stock, they've given up equity in the company. But with preferred stock, they have not given up equity. We do that calculation of earnings per share, earnings per common share. Preferred stock has nothing to do with shares outstanding and how you actually pay or how you calculate earnings per share or return on common shareholders' equity, return on equity. Preferred is always calculated out. That's why you always go back to that ratio chapter, net income minus preferred dividends divided by common shares outstanding, or in the case of return on equity, common equity outstanding in dollars gives you a return, a percentage. So that's the concept here in this chapter. If you look at page 216, 217, there's companies like Standard & Poor's and Moody's are the two better known companies that give ratings as far as what the debt is. And see, this is bonds. How likely are the bonds to default, right? The lower the credit rating, the more likely the bonds are going to default. But at the same time, the lower the credit rating, the higher the interest rate is going to be paid, right? And the better quality companies, they don't have to pay out but a lower rate. It's just the way it is. It's just a part of risk, the risk assessment of the company. So on page 217, bond fundamentals, 3 key fundamentals of bonds: the interest rate, the term, and the principal. What's the maturity value? Another part of this as well is what interest rates change. You print these bonds up and maybe you got a $1,000 bond with a face value of 4% for 10 years, 4%. Well, what if the market is paying 3%? What if interest rates have dropped and you still have these bonds you haven't sold? Because you're not selling them all at one time. You just sell enough bonds to raise capital for whatever your business plan is. So if interest rates are market rate is 3% and you're paying 4%, and that $1,000 denomination, you're going to be able to sell that at a premium. Remember that concept, premium, which means that $1,000, you might get $1,040 for it, right? Because over time, if you're paying 4% and the market's paying 3%, people want your bonds. And so you do the present value of those interest payments and the present value of that lump sum payment at the market rate of interest. That's what they're talking about here in Bond Fundamentals on page 217. Well, the opposite is true as well. What if I'm paying 4% on that same $1,000 bond, but now the market interest rates are going up, the market is 5%, right? Who wants my 4% bond if I can go to the market and get 5% for that $1,000? Well, in that case, what do I do with that $1,000? Well, when you calculate the present value at 5% and the lump sum payment of that $1,000 at the end, the present value that says is going to be discounted. So that $1,000 denomination, me as a company that's selling these bonds, I'm only going to get maybe $980 for that bond, because what? I'm paying 4%, the market's paying 5%. The market rate of interest is used to calculate the present value. And so there's a premium and there's a discount. If I'm paying 4% and the market's paying 4% par value, then it's $1,000. There is no calculation. It's easy. There is no discount. There is no premium. And that's very important. Top of page 218, you can see they're talking about short-term, intermediate, and long-term bonds. Short term's up to 5 years, intermediate's 5 to 12, and beyond 12 is what? Long term. What do you think happens if you're selling bonds that have a long maturity and you're paying 4%, and now the interest rates have gone up to 5%, and you've got a 20-year bond? What's that going to do to the price of the bond versus if it's a short-term bond, 5-year? Well, it's going to have a more drastic impact on the value of the bond, because you're locked in for that entire 20 years versus maybe 5 years. So the longer the maturity, the more swings you're going to have in the value of your bonds that you've sold. Of course, once you sell them, you don't really care. It's just people, if you're on the other side of that, you as a company that is selling these bonds, what if you're buying bonds as an investment, as an asset? You do care about it then if you're going to trade these bonds, if they're available for sale. If interest rates are going up and you've invested in a bond that's paying 4%, interest rates are now 5 or 6%, and you want to sell those bonds, you're going to lose principal, because that's the nature of interest rates. As interest rates go up and you've got a bond, you've invested in that bond, you're going to lose value. The opposite is true. Now, you go back to 1981, 10-year treasuries were paying 15%, 16%. You could get a CD for 1 year back then for 16%. 1 year, can you believe that? Now you can't get 1%. And since that time, interest rates have been going down. I guess I would go the other way. Interest rates have been going down, right? Since 1981. The 10-year treasury today is paying 0.65, I believe, less than 1%. So people have invested in bonds 40 years ago. There's been ups and downs, but long term, compared to nearly 40 years ago, people have made a lot of money in bonds by the fact the interest rates have gone down. All right, valuing a bond. I sort of talked about that a little bit. It has to do with cash flows. Bond value behavior, I talked about that, how the value will go up and down, especially if you've invested in those bonds. If you've sold those bonds, it doesn't matter. Of course, if I sold bonds that were paying 4%, what if interest rates are 2% now? Do I want to keep paying 4%? If those bonds were labeled as callable, then I can bring those bonds back, pay them off, and then reissue new bonds at 2% if they're called callable bonds, right? You got callable preferred stock as well. If you're paying a dividend that's higher than what you'd like to pay because interest rates have gone down, you want to call those in. Probably not as big an issue now that interest rates are so low, but that's been an issue for the last 40 years. That's what's in this textbook. Preferred stock, common stock. Again, common stock is ownership in the company. Don't forget that. When you look at the big picture, there's always, when you look at financial statements, it talks about authorized stock shares, authorized, issued, and outstanding. Authorized is how much a board can sell. Maybe there's 1 million shares authorized by the board. Maybe the issued is 500,000 and the outstanding is 400,000, right? So I wonder what that means when you look at that from the big picture. Let me draw a bullseye here and show you. You got 1 million shares that are authorized. You got 500,000 that are issued, meaning sold. When you ever hear the word issue, that means sold. And then maybe you've got within that 400,000 that are outstanding. What does that mean? 1 million authorized. These are shares of common stock. Now this is going back to 2010 days, principles of accounting, or 2020, excuse me. Shares of common stock, 1 million authorized, 500,000 issued, 400,000 outstanding. Issued is what you've sold at some point to raise cash for your company, right? It's on your books. That's common stock. Debit cash, credit common stock. But what's the 400,000? What's the difference between issued and outstanding? Because outstanding is what's used to calculate earnings per share. It's what's used to calculate return on equity, right? So what is outstanding versus issued? Treasury stock. TV talks about it, they call it corporate buybacks, meaning they went out and bought 100,000 of their shares back, probably because they think it's a good investment or to satisfy stock options that the company has. So they, in essence, have taken 100,000 shares off the books from the standpoint of calculating earnings per share and return on stockholders' equity. Because that calculation is net income, earnings per share is net income minus preferred dividends divided by common shares outstanding. All right, very simple. Earnings per share, what everybody is concerned about, because that's your net income minus preferred dividends, because that's an after-tax payout from cash and retained earnings, divided by common shares outstanding. So you can see if a company's revenue is stagnant or expenses are stagnant, net income is stagnant. If I decide to buy back some of my stock, if I have enough cash, I can make my earnings per share go up, right? And the same is true on my return on equity. Because return on equity is the same numerator, right? Net income minus preferred dividends divided by your average stockholders' equity, dollars. Return on equity, net income minus preferred dividends divided by average stockholders' equity. That's dollars. Dollars divided by dollars is a return, right? Dollars divided by dollars. Top part was dollars divided by shares, right? Dollars divided by shares gives you earnings per share, dollars. The bottom is a percentage, right? Dollars divided by dollars is a return. Very basic. And what you're looking at in this chapter, we've already talked about that previous in one of the chapters on ratio analysis. All right. Top of page 226 or bottom page 226, price earnings ratio. Very important for you as a business leader. You know, we calculate earnings per share. What's PE ratio, PE multiple? Well, that's the price of your stock. What's the market price divided by the earnings per share? And it gives you a multiple. Right now for the S&P 500, it's about a 25 or a 26, maybe even higher, extremely high. The long-term average PE multiple is more like 14. When I graduated back in the early 80s, I think in 1982, summer of 82, the PE ratio was about a 6. So if you took the market price of all S&P 500 companies, weighted average, and divided that by the earnings per share of those companies, the stock market was valued at 6 times earnings, extremely low, which tells you it's a great time to invest in the stock market back in the early 80s. And now it's more like 26, more than 4 times higher. It's just a new world order, maybe. Obviously more knowledge than it used to be. I don't know if they'll ever return to 6. If it does, then you probably don't want to be holding stocks right now. I don't think it'll ever return to that. I can see where it could return back to 14, the long-term average, which that would be quite a decline, wouldn't it? Be almost 50% reduction in the stock market, and that would come down. Of course, for that to happen, probably the earnings per share is going to go down as well. So there's a lot of things that, a lot of cross currents when we start talking about valuations of stock in the stock market. All right, that's as much as I'm going to talk about in chapter 14, since I've been talking here several minutes. Very important, the financing of your corporations through debt, bonds payable primarily, notes payable, mortgage payable, but primarily bonds payable, and then, of course, giving up equity through common stock. Chapter 15 is about cost of capital. I am sure you will cover that exhaustively in your finance class, since those classes are geared toward what's the most expensive part of debt, or what's the most expensive part of financing. Is it debt? Is it preferred stock, or is it common? They got a great little example in here. I would really encourage you to read this chapter on your own. The weighted average cost of capital on page 238, 239. Again, very simple and effective, very short chapter. So read that on your own. We don't have a case related to weighted average cost of capital because, again, even though this is in an MBA book, this is MBA Fundamentals of Accounting and Finance. So some of this you're going to pick up when you take your finance class. This is strictly accounting that we've been looking at. All right, chapter 16, capital budgeting. Capital, very important part of really finance and accounting, but accounting are the ones that are doing all the heavy lifting when it comes to capital budgeting. And when you talk about capital budgeting, that usually runs concurrent with your operating budget. So what's the difference between capital and operating budgeting? Well, operating budgeting is about your revenues and your expenses. Two things, revenues and expenses. What's your net income projected to be? That's operating budget for the next year. And longer plan would be 3 to 5 years. Operating budgeting. What's capital budgeting? That's how are you going to spend your cash in investing in fixed assets or intangibles. All right, well, we've looked at in a couple of these cases in the past, being depreciated. Well, depreciation is a non-cash expense, right? That's why you always add it back in your statement of cash flows. It's non-cash. What's the journal entry? Debit, depreciation expense, credit, accumulated depreciation. There's no cash involved, like paying wages, all right, or buying materials, buying spare parts. Cash is involved. But with capital budgeting says, of all my cash here, how am I going to take that cash and invest in my fixed assets for the future? Property, plant, equipment, and intangibles, fixed assets. A lot of terms for the same thing. And companies have covenants to where if they're highly leveraged like an Exxon was, you can't just go out and spend whatever cash you want on investing. You have restrictions there. So you have what the economists call scarce resources to use in investing in your company's property, plant, and equipment, and intangibles. Things like patents and copyrights and so forth. So capital budgeting here in this chapter is about developing a budgeting plan for capital. We did that every year at Lear and every year at Exide and Nuclear Fuel. Every company plans capital unless you don't need capital improvements. If you're a small nonprofit, we didn't do much of that at First Tennessee Development District. But with large manufacturers, where are you going to invest your dollars as far as equipment and potentially plant expansions? Very important to see how you prioritize that cash, because you can't just go out and spend whatever it is you want. And they show the process there on page 246. Proposals are developed. Engineering is usually in charge of that, even if it's environmental, engineering. Plant facilities falls under engineering, usually your networks, your software, hardware associated with that. All of this falls under engineering with close supervision by me as a controller. And the operations leaders of your company are going to watch to see what is taking place here as far as the priorities, because there should be an overall corporate strategy that flows down to the plant level. That's where the dollars are going to be spent. Supply chain logistics has a say in that, as far as where's the tooling going to be invested that's going to drive your product or generate your product. Formal reviews. Management must decide which proposals take priority. How do you decide which one takes priority, right? And what's important there on page 246, because they give sort of a brief outline, and then we're going to go into the details on how you do number 3, which how do you prioritize your projects. Expenditures are made for approved projects. They are implemented. Results are monitored. Number 5. Number 6 has gotten very popular in the last few years. Post-audit is often performed to gain valuable feedback. These projects that are being implemented, now some of them you have to implement. If it's EPA or OSHA or some regulation, that regulatory requirements, you've got to put that in. It doesn't matter if there's any type of return or not, or payback. Because if you don't do it, you get shut down. Very simple. That's your first priority. Second, usually, is your quality assurance areas, things that you're going to do to maintain and improve the quality of your product. And your process variation, Six Sigma, is so important to companies, whether it's your manufacturers and even companies like Ballot in healthcare. They're looking at things like that to increase the throughput through lean initiatives and also process variation. So those are second. Then it comes down to all these projects that are going to save you money or avoid cost, right? Cost avoidance and cost reduction, 2 different things. Avoid potential costs in the future and cost reductions based on historical empirical evidence. So we'll look at that here shortly, some of these methods to actually calculate return on investment. Page 248 is the initial investment here. And again, you have to be cognizant as financially as to what's going to be in your actual project. You can't just say, well, I want to put the initial outlay in there and the rest of these items like installation costs I'm going to ignore. Well, if you're going to ignore installation costs, then you're going to have to expense that, and that needs to be in your operating budget, right? You got an operating budget, you got the capital budget. Your operating budget, revenues and expenses. But installation costs, we bought a $9 million piece of equipment over in the UK back at Exide in the late, 2008, 2009. And that $9 million, that was just the cost of buying the equipment from the manufacturer. To put that in our facility, of course, you had freight coming in, right? Freight in, that was allowed to be added to the cost of the product, just like freight in on raw materials is the cost of your material that you're manufacturing. But installation costs, people that we hired locally, whether it's electricians or plumbers, HVAC, ducting, all of that is allowed to be put into the capital project and then be depreciated. Now, you don't have to, you can expense it, but most companies want to put that into their project. Well, you got to make sure you don't just have a $9 million capital approval for this. You need to have $9 million plus all these other installation costs, the freight costs coming in. So very important. And those are the ones that always jump out at you. The one that you have to ignore are training. Let's see, just lost the picture here. All right, now I'm back. All right, then the people spend a lot of money, companies spend a lot of money on training costs. Well, training costs have to be expensed. They cannot be capitalized. Training is going to be expensed from the get-go. So you always have this train, who was in training, who's in installation. You've got to be careful about that you don't violate accounting procedures and what's allowed to be capitalized and then depreciated. We talked a lot about that in 2 of these cases already. Of is it expense or is it capitalized? All right, continuing on, talking about disposing of other assets. That really doesn't really come into play that often. Operating cash flows. What they don't talk about here, maybe it's in the next chapter. That probably is in chapter 17. The actual process of, chapter 17, go ahead and jump over there. And be sure at the end of each of these chapters that you look at the key points to remember, like on page 256. You do these short tests. Again, it's up to you. I'm not testing you on what you learn here or in this other book like this, but you, and some of you have really taken to this, and I know you don't have an accounting background. You've learned a lot in this and how you've written these cases and understanding what goes on with things like the materiality case of those spare parts. Yes, spare parts and tooling, consumables. Those are being expensed immediately when they were purchased, and the company changed to where they want to capitalize that, but not capitalization in the sense it's going to be a fixed asset to be depreciated. These are consumables. That's why they kept saying these things are used over and over and over again. They're like supplies. So they were capitalized. They decided to capitalize those tooling parts, not tooling parts, and then expensed, put it in inventory, then expensed when they were requisitioned out of the parts crib on the production floor and used to repair tooling, production equipment, infrastructure, all of that. Immediately expensed, not depreciated. And some of you really picked up on that. You have to read those cases close for that. But the more you understand about what's in here and here, you're going to understand what they're talking about with what is a fixed asset versus what is inventory, right? And then there's other types of inventory. Usually people talk about inventory. It's your raw material, your work in process, your finished goods. That's your sellable product. That's what you're building with your equipment, with your fixed assets. All right, so again, I'm leaving it up to you to learn this on your own in order to write responses to those cases. Somebody have done a terrific job on that. I applaud you for it. Again, classes like this that are online, I mean, it's up to you. What you want to get out of the class is up to you. It really is. That's what education is. All right, chapter 17 is capital budgeting techniques. Now, the very first one they jump into is what? Payback period. Why is that? It's simple. Everybody understands it. You know, usually you'll have an Excel spreadsheet for each capital project that you develop. And that Excel spreadsheet might have 20 tabs across the bottom with accounting rate of return, internal rate of return, net present value, payback period, then a description of the project, environmental constraints, right? When's it the timeline, when it's going to be started and ended, when the production is going to be able to be used, depending on what type of project you're talking about. Again, not your regulatory requirements that are going to be approved if they don't have any payback whatsoever, and then ones that are quality assurance. Although quality assurance oftentimes can drive payback because you don't want to lose a customer, do you? Right? You got Toyota as your customer, and you have to implement better equipment on a process to lessen the turnbacks, lessen the process variation. Well, you're going to do that, and you can do the payback as what's the lost business for that? How many millions of dollars if you lost their business? But by and large, a lot of these are just general improvements, cost reductions and cost avoidances. And that's where payback period is what everybody can get their head around. Most people don't understand net present value, internal rate of return or accounting rate of return, but they do understand payback period, because what is payback period? It's simply, what did I invest divided what's my cash flow back each year, right? What's my investment? What if I invest $1 million, right? And I expect to have $50,000, let's just say $150,000 a year cash flow. I invest $100,000 and my cash flow every year is $150,000. So the top part is my investment, the bottom part is my cash flow. So what's $1 million divided by 150? 6.67. Payback period is 6.67 years. I'm going to invest $1 million and have either cost avoidance or cost reduction of 6.67 years. That's really a long time. You know what the threshold was at Exide and Lear? I'm going to throw both of them in there because Exide struggled financially $2.4 billion company struggled financially to break even every year. Lear, very successful, $14 billion company that made about $1 billion a year. But they both had the same policy at the plant level for investment. You know what the payback period required was? Because nobody ever talked about those other measures, even though the accountants put all that stuff out there. The payback period was 1 year or less. If you didn't have a payback of 1 year or less, they wouldn't allow you to spend capital dollars. That's shocking. I always thought it was. That's what it is. They just look at cash is so valuable to these companies that maybe a Google and Facebook, ones like that, or Apple. Nobody's more cash rich than Apple. I wonder what their payback period is for an investment. But 1 year was the minimum. Anything beyond that, they'd kick it out. And then that's where it comes in that a lot of times accountants are under pressure, controllers are under pressure to pencil whip it, work the numbers to where either you're going to increase the top part or you're going to decrease the bottom part of that investment or cash flow. Well, of course, the investment you can't really change, right? So increase the bottom part, the cash flow of what you expect to save or earn in order to make that number be what? 1 or less. Happens all the time. But the problem is, in the past, in the old days, nobody would come back and check to see if your numbers matched up. But what did I say about that back in chapter 16? Page 246, number 6. A post-audit is often performed to gain valuable feedback. Yeah, like find out if people lied and cheated to get their cash to actually invest in something that didn't have but a 2-year payback, right? So those audits are very common now. And it's not just internal audit that's doing it, it's external audit gets involved, because if they think you're doing something improper with that, then what else are you doing things improper, not following appropriate guidelines? It's like, again, going back to materiality, since we just finished that, or when I'm recording this, we just finished that. You since have completed the cash flow and probably the fraud case. Internal controls coming up next in this, where this video falls. But in that materiality case, you remember they changed to a more appropriate matching of expenses with revenue by inventorying spare parts, then expensing it to coincide with the repair of that equipment that is producing revenue. That is theoretically the better route. Although you can argue just expense all that stuff like they have in the past, get rid of it because it's spare parts. It's not worth, it's not material. But since they decided to actually put that on their books as inventory, $300,000, right? If you remember that, as you tried to flush it out. And then they need to restate the prior year, $175,000 on the books, right, as a balance sheet, and increase income. That's required, a change in principle. SFAS 154 talks about that. ASC 250-10 talks about that, about restatement if you're going to do that, and whether or not you disclose. And yeah, the link that I gave you, and some of you went beyond that to look at a lot of different measures. It's a judgment call, right? The 5%, the 300,000 divided by 6 million of revenue in that year, right, was 5%. Well, 5% is the bottom of that window. 5 to 10% is judgment. But you can say, well, it's a judgment call, and I decide I'm not going to disclose. Well, the question is going to be, well, your auditor is going to ask, well, why? Why don't you want to disclose it? Why don't you want to tell your investors and your creditors that you changed your policy, your accounting principle, to where you are actually inventorying this and then expensing when it actually occurs? Because it's really just a one-time bump. I know you're changing the prior year, but it's really just a one-time bump what you're doing going forward. Unless that 175 is 300 and 300 is going to be 500,000 next year, possible. But at some point it's going to level out, and it's not going to matter as far as what hits your income statement, if you follow what I'm saying there. So your auditor is going to ask, well, why are you changing this? And you're not telling anybody, because they'll ask, I want to see your policy for executive compensation. Are you going to go back and pay them a bonus on that 175,000 from last year, increase in income? Are you going to pay on this 300,000 because you changed the principle? Or are you changing principle because you want to be more theoretically correct and match expenses with the revenue as they are produced, which is what changed into this capitalization of inventory or capitalization of this spare parts in the inventory is doing. So a lot of questions come up on that. A payback period, drawbacks, well, it doesn't take into consideration time value money, but if you got a company that requires a 1-year payback, there's no such thing as time value money, right? Especially if the rates as low as they are now, it gets less and less important. 40 years ago, it was a big deal. Back when rates were 15%, and to a lesser extent through the years, become less and less of a factor. Net present value, 262. Internal rate of return, 264. All important for accountants. We love stuff like that, but not nearly as important as payback period because nobody understands it except financial people. All right, so that is MBA fundamentals. And we will next time look at the video probably on cash flows. Thank you for listening. I hope you've learned from this lecture.